Welcome to the 3 Edge Week in Review for the week of April 19th, 2021. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge. I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing an important topic, investor behavior or investor emotions. But first, let's take a brief look at what happened in the capital markets this week. And it's really been an up and down week on Wall Street. Thursday, stocks were hit by news that President Biden is proposing to nearly double the capital gains tax rates on wealthy individuals in order to help pay for the president's fiscal stimulus plans. This news is now causing investors to have to consider the potential negative implications of higher taxes against the benefits of infrastructure spending. Easy monetary policy remains in place, could continue to support global equities going forward from here. However, the trajectory of a post-pandemic global economic recovery is perhaps a bit less certain as cases of coronavirus worsen dramatically in some parts of the world, with India being the current epicenter of the virus. So let's get started on our topic for today. And at 3Edge, we believe that part of our responsibility towards our investor clients, along with managing the assets that you have entrusted us with, is to provide helpful information and to pass along what we may have learned about the markets based on the fact that we've been doing this for 40 years. Which brings us to our topic for today, investor psychology, and in particular, investor emotion. We know that over the course of human history, the power of human emotion can oftentimes cause investors to repeat the same investment mistakes over and over again. And particularly now, after an extraordinary 12 months of equity market returns, this could be a dangerous period of time for investors. At some level, we all know that we can be driven by two opposing emotions when investing, fear and greed. And both of these emotions are powerful. And importantly, most of the time, we know that making investment decisions based on emotions doesn't necessarily serve our best interest. As we know, emotions are a reflection of what's going on in our minds. And quite often, as investors, as human beings, we find that our minds are either focused on the past and maybe regretting past investment mistakes, or anticipating the prospect for potential investment gains or fearing potential future investment losses. And so to start off today's discussion, I want to display a chart which has been one of my favorites for years. It's by Carl Richards at thebehaviorgap.com. And it demonstrates an extreme picture of what can happen to us as investors if we allow ourselves and our investing behavior to be driven by the powerful emotions of fear and greed. Now, the chart is obviously a bit hyperbolic and tongue-in-cheek, but I do think that perhaps it's familiar to us. We can all see ourselves in this chart a little bit. And the story, goes something like this. You start at the left-hand side of the chart. The market is low, but it's going up. But we're hunkered down in cash because we sold near the bottom of the last rally, and we're too afraid to get back in because we know that as soon as we get back in, the market will go down again. So we wait, and we wait. And the market continues to rise. And finally, we are overcome by the fear of missing out. And so we get back in, and maybe we get back in right where that greed buy arrow touches the line. The market goes up a little longer, and then it turns down. However, this time we commit to not being fooled into selling like the last time. We'll just wait for the market to go back up. But the market keeps going down and keeps going down. And finally, we can't take the pain anymore, and we sell out our entire portfolio, maybe just where the fear sell arrow touches the line and just before the market heads back up. And this may not be a recipe for going broke, but it certainly isn't a recipe for successful investing. And the point of this chart is not to make fun of anyone. We're all driven by these emotions. At 3Edge, we know these emotions very well. But the trick is to recognize these emotions and have a discipline, and in our case, a model, an investment experience, which enables us to not fall prey to the emotions of fear and greed when making investment decisions. So Steve, right now, there are a plethora of signs of market euphoria, record amounts of investment leverage, meme investing in stocks like GameStop, SPACs, cryptocurrencies going up and down. And what's weird about this to some extent is it starts to feel normal, which is kind of weird, and it's tempting to believe that this will just go on just the way it has for the past 12 months, will just simply continue on indefinitely. So my question for you is, are we at a real danger point at this point in time? Are we at the point where investors may just throw up their hands and say, forget it, I'm putting all of my money in the S&P 500, in the US stock market? What do you think?
Well, there's certainly evidence of that, Fritz. And as you point out, one mistake that investors keep making over and over again is that they extrapolate recent performance and then act as though that recent performance is going to continue indefinitely into the future. And I can think of a time in history, very famous, widely respected economist, Irving Fisher, was once quoted after a strong run-up, similar to what we just had over the last 12 months. Stock prices have reached what looks like a permanently high plateau. And that was his quote. This was 1 week before the famous stock market crash of 1929. So even the most experienced, intelligent investors can fall prey. Now, we model many factors that go into what drives the global markets. And we do that over time. And the one category, the one set of factors that, based on our modeling, just never changes through history, through decades, going back centuries. The one factor that just never seems to change is the human behavior, the investor behavior, the human psychology factor. We're built with this fight and flight response inside us. We do respond to fear and greed, like you said, and that just seems to be constant. Now, you talked about how after a while life can seem normal, whatever is happening, and certainly the last 12 months have been extraordinary, the last 12 months ending March 31. So I'd like to share this chart, and it compares the last 12 months of the US stock market with the long run average, the average experience of the US stock market over the last 150 years. So over the last 150 years, US market has gone up on average about 9% a year. Some years a lot better, some years a lot worse, a lot of volatility, but on average, 9%. The last 12 months, it's up 56%.
Crazy.
Now, we looked over the last 150 years, that's 1,800 months. And over the 1,800 months, the last 12 months is in the top 1 percentile of history. So this is absolutely not normal. And what this means is that when investors extrapolate the recent performance into the future, we're seeing investors that, more and more money is going into the market. We've had more money going into the market in the last few months than the last several years. Mm. And we see margin debt. People who are putting more money in the market than they even have, they're borrowing extra money just to put it in. They're so confident this is all happening. And yet we believe more than ever that it's more important than ever to diversify and not fall prey to that, that we're going to extrapolate the recent past.
So very good. So perhaps it would be instructive also to understand, to take a look at market history and to take a look at those periods when we did have a dramatic run up in a short period of time, and then to look also at, well, what were the subsequent returns following those dramatic run-ups?
So this can certainly be instructive. Let me share another chart with everyone. And what we're looking at are some of the very top performing 12-month periods over the last century. And we'll begin with the sharpest of all. And that is the period from June of 1932 to June of 1933. After the famous stock market crash in 1929, we went into the Great Depression. Market fell 83%, bottomed out in June of 1932, and then rebounded and soared 165%. And so people, after being so fearful, after the end of that year, started to say, well, maybe it's safe to get back in the market. Well, over the next year, it fell another 17%. Second period, March of 1936, and the 12 months leading into that, the market was up 83%. And a lot of people got excited, well, maybe this time we're really out of the woods. And then subsequently, the market fell 37%. Third period, coming out of World War II, the market took a huge hit. In the beginning of World War II, it looked like we were on the side of the Allies that was losing the war. But then things turned around, and the market took off, and we were up 62% in the 12 months ending in April 1943. And then following that, the market continued to go up, but much more modestly. In June of 83, we were coming out of the beginning of the big bull market that started in the summer of 1982. The market had done terribly before then. We're now recovering. A lot of people were skeptical, but now the market's up 61% in 9 months, in 12 months. And people are jumping in. Well, over the next time frame, the market fell 7%. And then finally, we talked about the crash of 1929. The market, just like the last 12 months here now, was up 57%, and then it fell 83% over the subsequent several months. And so what remains to be in store is certainly a question mark. And there's no rule that says the market cannot continue to rise from here, but just a word of caution, it's not guaranteed. And we still believe that now is a more important time than ever to be diversified.
Excellent. So right. So we know that after a period that we've had the last 12 months, the market, it can continue to go up. And it's tempting to begin to believe that the market euphoria will continue indefinitely, and it may continue for a while, as you said. However, all market manias eventually come back to earth. And this is an important reason why at 3Edge we construct portfolios that are designed to participate in the up markets while seeking to protect our clients from the market corrections that can be so painful to their investments. That's why sometimes I like to refer to our strategies as disciplined four-wheel drive portfolios. So that will do it for Steve and me. We'll be back next week with another edition of the 3Edge Week in Review. Remember, all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And you can subscribe to our 3Edge YouTube channel in order to be notified as we release additional videos in the future. In addition, if you'd like to submit a question or make a suggestion for a future topic, we'd love to hear from you. You can write to us at Week in Review, all one word, Week in Review at 3edgeam.com. So now, on behalf of everyone here at 3Edge, we urge you to remain safe as we begin to emerge from the coronavirus pandemic. Stay strong, keep the faith, and thanks for listening.